Ladies and gentlemen, good day and welcome to the Q3 FY26 earnings call of Arisinfra Solutions Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. Today we have with us Mr. Ronak Morbiya, Chairman and Managing Director, Mr. Srinivasan Gopalan, Chief Executive Officer, and Mr. Bhavik Khara, Whole-Time Director and Chief Financial Officer. We will begin the call with the opening remarks from the management, after which we'll have the forum open for the interactive Q&A session. I must remind you that this conference call may include forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company has on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Srinivasan Gopalan, Chief Executive Officer of Arisinfra Solutions Limited, for his opening remark. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen, and thank you for joining us. Before we begin, a quick update. Over the last few months, we have evolved our brand from Arisinfra to calling ourselves simply Aris. This reflects what the business has grown into. Aris today is not just an infrastructure supplier. It is a network and an organized execution backbone for construction materials. The simpler name aligns the brand with the role we now play across supply, execution, and risk management in the construction ecosystem. Before stepping back into the broader context, let me briefly share what Q3 looked like for us, because this quarter clearly marks a step change in the business. Let me quickly run through the excellent performance that we have had this quarter as compared to last year's same quarter. Last year's same quarter, we had a revenue of 181 crores, and the same period this year is 270 crores, marking a 50% rise in our turnover. The gross margins have done exceedingly well, from a 15.5% in Q3 2025 to a 17.4% in Q3 2026, an increase of almost 200 basis points. The EBITDA increased 2.3 times from a mere 13 crores to a 30 crores, and the EBITDA percentages last year was at 9.38%, which has improved itself to 11.75%, and the PAT increased 9 times from a 2 crore to an 18.27 crores this quarter. There are reasons for these things to happen. Apart from the profitability that we spoke about, it's important to know the net working capital days. The net working capital days in Q3 2025 was 116 days, which has come down drastically by 42 days to 74 days. The increase in gross margins and EBITDA are very, very clearly defined and an outcome of the strategy that we have clearly worked on. The contract manufacturing portion, which is a highly profitable venture, increased from a 35% of turnover to a 48%. From a numbers perspective, it increased from 65 crores to 130 crores, almost 2 times. Similarly, the services where again the margins are exceedingly high, the percentage on sales last year was at 6%, which increased to 9%, and in absolute terms, increased from a mere 11 crores to a current 24 crores, showing more than 2x growth. To put the performance in perspective, it's important to briefly look at the environment we are operating in and the opportunities that we have in front of us. India is currently executing one of the largest infrastructure build-outs in the world. The government of India has budgeted close to 11 lakh crore of capital expenditure in financial year 26 alone, nearly 3 times what it was 5 years ago. Large expressways, freight corridors, metro networks, airports, ports, and urban infrastructure projects are under construction across the country, spanning multiple regions and asset classes. What stands out is that while these projects are large, organized, and institutionally funded, the materials that build them, namely aggregates, concrete, and allied inputs, are still supplied through a fragmented and largely informal system. As project sizes grow and timelines tighten, the lack of an organized execution-led distributor layer becomes a real bottleneck. This is not a pricing issue. It is fundamentally an execution, reliability, and risk management issue, and that is precisely the gap Ares exists to address. Coming back to our business, one of the most important shifts we are seeing now is where profitability is coming from, not just how fast revenue is growing. Ares operates across three segments: B2B trade, contract manufacturing, and services. And together they form a very deliberate progression in how customers engage with us. B2B trade acts as an entry layer. It gives us scale, customer relationships, and steady demand across regions. As these relationships deepen, a larger share of business naturally moves into contract manufacturing, where we secure capacity, improve utilization, and bring predictability into supply, achieving the economics of manufacturing without owning plants, vehicles, or carrying the operational burden of running them. The most powerful shift, however, is in our service offerings. While services contribute a smaller share of revenue, they already contribute a disproportionately large share of EBITDA. This is because services are built on execution capability, systems, and trust, not on deploying capital. As this segment scales, EBITDA grows with very little incremental capital. What this mix shift tells us is very important. As the business moves from trade to manufacturing partnerships and into services, profitability improves while capital intensity reduces. This is why EBITDA is now growing faster than revenue and why returns on capital are structurally expanding as the mix shifts towards services and contract manufacturing. Looking at performance over the 9 months, revenue stood at 724 crores, representing a 33% year-on-year increase. More importantly, EBITDA has grown by around 54% year-on-year, and profit after tax has increased nearly 6 times over the same 9-month period as compared to last year. This clearly shows operating leverage and improving earnings quality. Equally important is how this growth has been funded. Despite rapid scale-up, net working capital is reduced from a well over 116 days last year to below 75 days now, unlocking capital within the business. This improvement has been driven by tighter credit discipline, better counterparty quality, and technology-led monitoring of receivables and execution. The practical implication is straightforward. The business can now grow faster without requiring proportionately more capital, which is often the key concern investors have in this sector. When you put all this together, what becomes clear is that the model has entered a new phase. Scale is improving margins, margins are improving cash generation, and stronger cash generation is reducing capital intensity. This feedback loop is what allows Ares to compound in a disciplined and sustainable manner. As we move forward, our focus remains unchanged. Deepen execution capability, strengthen risk and credit control, and scale with discipline. India's construction ecosystem is formalizing rapidly, and the need for an organized execution backbone for construction materials will only grow from here. We believe Ares is well positioned to play that role and to do so in a very, very capital efficient manner. Thank you for your time. We are happy to take any questions that you have.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Deepak Podar with Sapphire Capital. Please go ahead.
Am I audible, sir?
Yes.
Yes.
Okay, okay. First of all, many congratulations for a great set of numbers. I could see a overall improvement. Even your working capital has improved a lot. So many congratulations on that front. So now I just wanted to understand on your mix. Now it's 47% B2B, 44% contract, and 9% is services. And that's a marked improvement from what we have seen last year. 33% contract manufacturing to 44% now. So how should one look at this mix going ahead? Though our focus remains on contract and services, but how are you seeing the mix?
Yeah, just like to rectify a little bit, the contract manufacturing segment now contributes to 48% of the revenue. It was 44% at the end of quarter two. We are seeing, improved utilization. Even while rapidly scaling, the revenue contribution has increased, and we expect that as the utilization improves going further, the revenue contribution will increase. And as we move, as we shift more towards asset-light manufacturing and services, the improved profitability is here to sustain, and that's how the model is designed.
Okay. So given improved profitability is sustainable, without other income, your EBITDA margin is close to 11% this quarter. So is that a sustainable thing that we should keep it as a base going forward?
Yes, yes. We do believe so because the improvement is structural. Margins are improving due to mix and execution, not temporary pricing or one-offs. As long as this mix continues and working capital stays disciplined, profitability should remain stable and improve gradually.
Understood. And is there any levers which can drive this 11% even further higher? Can you throw some more light on that?
At the moment, we are happy with how the model is turning out and with all the capital efficiency that is coming to play now. And the improved profitability is only a reinforcement of the business model that we have at play. So the focus is going to be on improving this mix, focusing on, capital efficiency. And as long as these underlying matters are in place, I think the profitability will sustain.
Okay, fair enough. And just one last thing, in terms of your growth, we have seen very good growth on your top line since last 2 quarters. 39% for second quarter and 49% in this third quarter. Now for this entire year, a 40% growth is what we have been seeing in the past. So we are on track for that?
Yes, we are absolutely on track for the guidance that we have given, which is 40% year-on-year growth. However, having said that, we are projecting good profitability as well. So yes, well in line to achieve the growth numbers that we are predicting.
Okay, and we are going into the strongest quarter, right? Fourth quarter ideally would be the strongest. So how's the traction? Can you throw some light? How's the on-ground situation in terms of traction on the customers?
Absolutely. Absolutely. Quarter 4 is usually the strongest. We have been preparing for this ever since we started going into December, planning our production lines, revenue visibility. And because of the projects that we are involved in, the customers that we have onboarded and the recurring orders that we've been getting, we have real good visibility on the demand, not just this quarter, but for the next 3 to 4 quarters. And that's why we are confident of achieving these good numbers.
Okay. So we have good visibility from customer in quarter 4 as well, right?
Absolutely, 100%.
Okay. And in the supply side, how are we looking at in the supply side in terms of getting more mills and all to contract with you guys? Can you throw some more light on that?
Yes. So yeah, 2 things here. With respect to contract manufacturing, as mentioned in the last call, we currently have about 9 million metric tons of capacity under our control through this network. And
how
that
much? 9.
Is spread.
We have 9, right?
9 million. 90 lakh metric tons annually. That is spread across stone aggregates and ready-mix concrete. But recently we also made an announcement, of entering a new segment which is called asphalt. And that's a segment which looks pretty exciting for the future. So that is one new vertical that we have added. We are in the process of forming a joint venture for the same. And we have executed 2 projects which kind of give us experience of how this business is done. And we have real good visibility with respect to the orders in the next few quarters. We made a couple of announcements in that aspect as well of a 35 crore order from an infra company, and we recently executed a small order for APCO in Mumbai as well. So contract manufacturing looks very, very exciting for the next few quarters.
Okay. And what can be the potential of this asphalt opportunity size for us?
Yes, we are projecting revenue in the north of 80 to 100 crores in the next 12 to 18 months.
In next 12 to 18 months?
Yes.
And margins are in line with the company level margins, or is it better?
It will be in line with the company level margins. Okay. And that is why we are confident of sustaining these margins as well as we go further.
Understood. That's very helpful, sir. That's it from my side, and wish you all the very best. Thank you so much.
Great. Thank you so much.
Thank you. The next question comes from the line of Kaushal Sharma with Equinox Capital. Please go ahead.
Hi, sir. Very good evening. Am I audible?
Good evening. Yes.
Yeah. So my question is on your congratulations, first of all, for a very good set of numbers. So my question is on your working capital side, sir. Could you please tell me what is the current receivables as on date in our books, and how much is for more than 6 months and less than 6 months, and what about our borrowings as of now?
Yeah, the current receivable number is approximately 385 crores, and above 6 months, the number is close to about 50 to 55 crores.
Okay.
And this
And
number
what
has come
about
down
the overall borrowings as of now?
Our current borrowings are in the range of around 40 crores, and this is only the working capital facilities and a small long-term debt of about 6 crores.
And so I can see in your result in note number 7 that we have utilized almost 100% of our working capital that we have raised through IPO. But now we are projecting a good aggressive growth of 35 to 40%. So how would we source these incremental working capital going ahead? And currently we are securing a good amount of capacities in terms of contract manufacturing, against which we require certain deposits. So if we expand our contract manufacturing as like we are growing, so we require certain amount for these security deposits as well. So how we are going to fund? Will this increase our borrowings going forward, and what kind of levels are we targeting?
Yeah. First, on the utilization of IPO proceeds for working capital, this is not locked up capital. These are vendor payments that are returned through customer receivables, and we have had 2 very healthy quarters of receivables. So it's back in the system, which are being reinvested as working capital. A note on trade deposits and advances. It's very important to note what these deposits are. They are a strategic enabler, not idle capital. Deposits actually help us secure capacity, prioritize supply, and better commercial terms in a fragmented ecosystem. In return, we get reliability and higher throughput without owning assets. So as utilization improves, incremental growth requires relatively lower incremental deposits. So that is the advantage that we have, or that is the model that we are operating on, where we invest one-time deposit to generate multi-year returns.
So what kind of sustainable borrowing levels are we looking in our business going ahead?
So I think we have mentioned this.
In this range, 40.
Sorry, sir.
So what kind of range are we expecting in terms of our borrowing going ahead?
We would be between 0.4 to 0.5 as our leverage at any point in time. We will not increase that. To answer your question specifically, though it shows that the working capital limits from the proceeds are used as mentioned by Ronak, these have come back as debtors collections, and we have a healthy cash balance of more than 150 crores in the balance sheet. So even if we have to create new capacities, we have enough gunpowder to provide deposits. However, if you look at the deposits that we have already provided and the kind of capacity utilization that we have, we still have around 30 to 40% room to go in the existing deposits itself.
Okay, so that will not increase our borrowings in the near future, right?
No, that will not.
Okay. And sir, what is our current existing contract manufacturing capacity, and what is our target in terms of securing further and
Yes,
utilization level?
yes, the current capacity is about 9 million metric tons. As of quarter 2, we were at a utilization of 45% plus. As of quarter 3 now, we are at a utilization of 55% plus. So there is significant headroom even with the current capacity that we have, and that is why we are confident that the revenue from contribution from contract manufacturing will increase as we grow further in the next few quarters.
And what is the terms of the security deposit that we need to give against securing this capacity? Like, when will these securities realize in our business?
So these deposits are refundable in nature. These are multi-year deposits. As and when the concerned plant utilization increases and improves to about 80% plus, and when the cash flows of that particular plant become healthy, these deposits will be returned back into the system and be invested somewhere else to increase the capacity. That is how these deposits are designed.
Okay, sir. Got it. Thank you very much for answering my question, and all the very best.
Thank you so much.
Thank you.
The next question comes from the line of Namesh Gupta, an individual investor. Please go ahead.
Hello.
Yes.
Oh, yes, sir, you're audible. Please go ahead.
Okay. Sir, congratulations on a very good set of numbers.
Thank you.
सर मेरा इसमें क्वेश्चन ये था कि सर हमारा ये जो वर्किंग कैपिटल डेज लाइक जो हमारे जो डेटर्स है अराउंड 120 to 130 डेज है, ये क्या हमारे इंडस्ट्री लेवल का जो बेंचमार्क है सर, लाइक ये वही है या हम उससे थोड़ा सा ज्यादा है या फिर कम है सर? एक तो मैं ये जानना चाह रहा था। और सर लाइक हमने आरएचपी में हमने कुछ कॉम्पिटिटर्स के नाम दिए थे, उसमें एक प्रोमिनेंट था इंफ्रा डॉट मार्केट। क्या उनका भी यही वर्किंग कैपिटल डेज है जो आप लोगों का है? मैं थोड़ा सा इस पे समझना चाह रहा था सर, इतना एलिवेटेड क्यों रहता है ये?
तो सर जो आप नंबर देख रहे हैं रिसीवेबल्स का, वो अभी
हाँ जी।
करीबन 18 और 120 के करीबन है ये नंबर, और हम ये नंबर इम्प्रूव करके यहाँ तक आए हैं। इंडस्ट्री स्टैंडर्ड देखे जो फंडामेंटल नेचर है इंडस्ट्री का, वो क्रेडिट एनवायरनमेंट पे ही चलता है। तो जिस इंफ्रा कंपनी और बिल्डर्स को हम देते हैं, उनका भी क्रेडिट साइकिल करीबन 90 दिन का होता ही है। तो जैसे कोई भी इंफ्रा कंपनी कोई भी रोड बना रही है, उनको भी जो बिल सबमिशन होता है और उनका जो पेमेंट आता है, ये सारा पूरा क्रेडिट पे ही चलता है। अगर आप इंडस्ट्री नंबर या स्टैंडर्ड्स देखोगे तो एक 90 से 100 दिन का रिसीवेबल का नंबर होता है, बट इसमें एफिशिएंसी तब आती है जब हम इसमें पेएबल्स का नंबर और पेएबल और रिसीवेबल के बीच का जो गैप है उसको नैरो कर पाए, जो हमारे नंबर्स में अभी दिख रहा है। हम 120 के करीबन थे, आज हम वो 75 दिन पे आ गए हैं। तो हमने करीबन 40-45 दिन का कैपिटल अनलॉक कर दिया है, जिसकी वजह से सिस्टम में एफिशिएंसी आ रही है। तो नंबर से ज्यादा हम क्वालिटी ऑफ रिसीवेबल्स को देखते हैं।
ओके। और सर जो हमारे एक और कॉम्पिटिटर है जिनका मैंने नाम लिया, इनका कुछ क्या होगा सर? क्योंकि ये भी आई थिंक सेम लाइन ऑफ बिजनेस में ही है सर आप लोगों के।
सर इनके बारे में इतना मुझे पता नहीं है, हम इनके बारे में कमेंट नहीं कर पाएंगे। बट जहां तक हम हमारी बात करते हैं, नंबर्स भी इम्प्रूव हो रहे हैं इन टर्म्स ऑफ रिसीवेबल्स, पेएबल्स भी अच्छा खासा इम्प्रूव हो रहा है विदाउट अफेक्टिंग वेंडर पेमेंट। और हमारा कंसंट्रेशन ऑन फोकस अभी नंबर से ज्यादा क्वालिटी ऑफ रिसीवेबल्स पे भी जा रहा है, जहां पर हमने बड़ी बड़ी इंफ्रा कंपनियों के साथ भी अभी रिलेशनशिप बनाया है, जहां पर से रिकरिंग ऑर्डर्स भी आ रहे हैं।
ओके सर, इसमें मेरा एक क्वेश्चन हो रहा है सर, लाइक हमारी एक कस्टमर रिटेंशन रेशियो क्या है सर अभी? लाइक हम इतने कई सालों से अब तो हम बिजनेस कर रहे हैं, तो एक कुछ कस्टमर रिटेंशन रेशियो भी हमारा एक डेवलप हुआ होगा ना?
यस सर, हमारा रिपीट अकरेंस जो है वो 80% प्लस है। ये थोड़ा डिफरेंट चलता है B2C सेगमेंट से, जहां पर रिटेंशन वैसा नहीं होता। यहाँ पर अगर हम एक प्रोजेक्ट में इन्वॉल्व है या फिर कोई इंफ्रा कंपनी जैसे बड़ी बड़ी ईपीसी कंपनीज है इंडिया में, अगर उनके साथ हम एक बार जुड़े हुए हैं तो यहाँ पर से हमको रिकरिंग ऑर्डर्स आते हैं, बिकॉज ये प्रोजेक्ट नॉर्मली 2 साल 3 साल 4 साल तक चलते हैं। तो जब तक आपका सर्विस अच्छा है, आप सोर्स कर पा रहे हो और कॉस्ट इफेक्टिव हो, तो आपको रिपीट बिजनेस मिलता ही है, और इसके वजह से हमारा वो परसेंटेज 80% प्लस है।
ओके ओके सर, मैं एक थोड़ा सा एक और क्वेश्चन मेरा है। आई मीन मैं थोड़ा सा एक्चुअली मैं इस इंडस्ट्री में थोड़ा नया हूँ, मैं थोड़ा ज्यादा समझता नहीं हूँ, लेकिन एक चीज समझना चाह रहा था सर। आपका बिजनेस मॉडल कुछ इस तरीके का है कि आप लाइक जो दूसरे कॉन्ट्रैक्टर्स हैं उनसे आप माल प्रोक्योर करते हैं, देन आप इनको बड़े बड़े डेवलपर्स को आप लोग देते हैं सर। तो मैं जस्ट ये समझना चाह रहा था कि सर ये जो कॉन्ट्रैक्टर्स हैं, ये लाइक आप भी यहाँ पे अराउंड 15 से 16% का ग्रॉस मार्जिन सर आप अर्न कर रहे हैं। तो ये जो कॉन्ट्रैक्टर्स है, क्या ये इतना चीप में आपको देंगे कि आप आगे आप अर्न कर पाए इनको देके? मतलब ये थोड़ा सा मैं बिजनेस मॉडल नहीं सर इस चीज को है ना ढंग से समझ पा रहा हूँ सर, अगर इसको थोड़ा सा बता
नहीं
पाए तो।
नहीं, बहुत 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 ही करेक्ट क्वेश्चन है ये। इसके लिए मॉडल जानना जरूरी है। हम जहां से माल खरीदते हैं वो कॉन्ट्रैक्टर्स नहीं है, वो
ओके,
छोटे छोटे मैन्युफैक्चरर्स और सप्लायर्स हैं। और
ठीक है।
अगर आप हमारी ऑपरेटिंग प्रॉफिट या प्रॉफिटेबिलिटी देखेंगे या ग्रॉस मार्जिन देखेंगे, तो इसमें सर मटेरियल्स का मार्जिन भी है और सर्विसेज का मार्जिन भी है,
ठीक
जो
है।
हमारा एक बड़ा डिफरेंशिएटर भी है। तो
ठीक है।
अगर आप हमारा प्रॉफिट देखोगे तो करीबन 30 से
हम्म,
40% सर्विसेज से भी आता है, जिसकी
ठीक
वजह
है।
से हमारा प्रॉफिटेबिलिटी बहुत अच्छा है। तो इसका मतलब ये नहीं है कि हम मार्केट में माल महंगा खरीदते हैं और महंगा बेचते हैं। हमारा वॉल्यूम डिस्काउंट्स बहुत अच्छा होता है, हमारा सर्विसेज का रेवेन्यू अच्छा है, और ये सब जब मिलता है और हमारा कॉस्ट कंट्रोल बहुत ही अच्छा है, तो इट इज ओनली बिकॉज ऑफ दिस कॉम्बिनेशन ऑफ सप्लाई सर्विसेज एंड टेक्नोलॉजी विच इज आवर डिफरेंशिएटर कि हमारा ग्रॉस मार्जिन और ऑपरेटिंग प्रॉफिट भी अच्छा है।
ओके सर, मैं इसी में जैसे एक चीज मैं जैसे मैं एक एक सिंपल सी चीज एक पूछता हूँ सर। आपके बिजनेस में लाइक आपकी पीपीटी में लिखा है कि आप लोग का एग्रीगेट्स का बिजनेस का काफी अच्छा है। एग्रीगेट्स का मतलब हो गया सर लाइक ईंट हो गए, ब्रिक्स हो गए, प्लस आपकी रोड़ी जिसको अपन छोटे छोटे स्टोन्स होते हैं। अब सर मैं जस्ट ये समझना चाह रहा था, अगर हमारा ग्रॉस मार्जिन 12 से 13% का है, तो जो हमें ये जो मैन्युफैक्चरर जो हमें दे रहा है, क्या ये इतने कम मार्जिन पे ये हमें दे पाता है कि हम भी उसके बाद 12 से 13% का मार्जिन हम लोग जनरेट कर पाते हैं? ये चीज मैं थोड़ा सा समझना चाह रहा था सर मैं।
सर एग्रीगेट्स का बिजनेस मैन्युफैक्चरिंग मार्जिन
हाँ
इससे भी ज्यादा होता है। अगर आप टिपिकल सेटअप देखोगे जहां पर एक मैन्युफैक्चरर एग्रीगेट्स मैन्युफैक्चरर ऑपरेट करता है,
हाँ हाँ
उसका
हाँ।
मार्जिन 25 से 30% तक भी जाता है,
ओके ओके
अगर
ओके
वो डायरेक्टली सप्लाई करे इंफ्रा कंपनीज को। तो एग्रीगेट्स
ओके
ऐसा बिजनेस रहा है कि मार्जिन्स हाई है, और उसका मेन रीजन ये है कि बहुत ही ज्यादा अनऑर्गेनाइज्ड है, छोटे छोटे प्लेयर्स होते हैं, और ये मटेरियल बहुत ही कॉम्प्लेक्स है और इसको बल्क में सोर्स करना मुश्किल है तब। और
ओके
ये मार्केट एकदम ही अनटैप्ड है, आज कोई भी ऐसा प्लेयर नहीं है जो एक मार्केट ओन करता है एग्रीगेट्स में। सो एग्रीगेट्स
ओके
बहुत ही एक्साइटिंग सेगमेंट है, तभी देखोगे हमारा सबसे ज्यादा रेवेन्यू एग्रीगेट से आता है, तभी हमारे मार्जिन्स भी बहुत बेटर है।
ओके सर, एक लास्ट क्वेश्चन और मैं जस्ट एक मैं पूछना चाह रहा था सर। जो ये नॉर्मली ये जो एग्रीगेट सप्लायर होते हैं सर, मैंने मतलब नॉर्मली क्योंकि मतलब जो मैंने जो देखा, ये नॉर्मली जो भी आपको सामान सप्लाई करते हैं सर, कुछ जीएसटी या कुछ वो नहीं होता सर, ये लोग कैश में डीलिंग करते हैं। और वो तो आप लोग का जो टैक्स सिस्टम है सर, लाइक जीएसटी गवर्नमेंट जो भी लगाती है, वो कैसे चलता है? क्योंकि सर इन लोगों का तो मैंने देखा कि नॉर्मली ये लोग उसी तरीके से बिल्कुल अनऑर्गेनाइज तरीके से प्ले करते हैं लोग। तो वो लोग आप उस चीज को कैसे मैनेज करते हो सर?
सर हम सिर्फ बी टू बी सेगमेंट में है, हम
ओके
रिटेल बिजनेस नहीं करते हैं। तो जितना
ओके
हम बी टू बी बिजनेस करते हैं उस पे प्रॉपर जीएसटी लगता है, और वो हमारा जितना भी बिजनेस हम जो सालों भर हम साल में जितना भी 350-400 करोड़ या 500 करोड़ का जो भी एग्रीगेट बिजनेस करते हैं, वो
ठीक
पूरा
है।
पूरा प्रॉपर जीएसटी लगाने के बाद ही होता है, ऑन पेपर होता है।
ओके, तो जो आपको जो सप्लायर दे रहा है, ये भी आपको जीएसटी लगा के दे रहा है सर आपको पूरा?
100%।
ठीक है सर, ठीक है। थैंक यू सर, थैंक यू।
थैंक यू।
Thank you. Ladies and gentlemen, if you wish to ask a question to the management, you may press star and one. Participants, if you wish to ask a question to the management, you may press star and one. The next question comes from the line of Kapil Ahuja with Equinox Capital. Please go ahead.
Yeah, hi, I'm audible.
Yes.
Yes, sir.
Yeah. Actually, I wanted to have some clarification on receivables. So you told that you have receivables of 55 crore above 6 months. So are they coming to company, or what is the status of the 55 crore receivables? Because 6 months is a bit confused.
Yes. So, the 6-month receivables as a percent of total revenue, close to total receivables, is just about 12 to 14%. This has been continuously moving, and every quarter we are seeing a reduction in the number of receivables. We expect all of these, first of all, are moving accounts. The ECL that we have taken, which is basically the expected credit loss, has been updated, and we are following a waterfall mechanism to calculate that as well. This 55 crores, all of the accounts are moving, and we expect this number to come down to about 30 to 35 crores by March, and then we expect further movement in the next few quarters.
So you are not expecting any write-offs in this
No, whatever we
above
are
6 months?
factored that in the ECL number, which is already there in our P&L.
Okay, fine. And secondly, regarding this is the same question that previous participants have also asked, or I wanted some clarification on this top line that you are growing 35 to 40% every year. For FY27, if you go for 1100 crore target as per your guidance, so how will you manage your receivables? Because even if you go for the 90 to 100 days of receivable cycle, so you will be having receivables of above 300 crore. So how they can't come from internal accruals, and how will you manage this working capital? Because I can't get a clarification on this.
Well, I think, yes, the concern would be that, the business would become more capital hungry as it scales.
Yes.
But
yes.
that concern normally applies to traditional models, not ours. We secure capacity instead of owning assets and services which are growing, scale with very little incremental capital. I mean, the fact that the net working capital now is below 80 days and it is continuously improving, down from about 120 days, it just tells us growth is becoming less capital intensive, not more.
So that could impact the margins also?
No, in fact, while scaling rapidly and the net working capital days down below 80 days, and with the gross margins improving to about 17% plus and EBITDA growing to about 11% plus, I think the efficiencies are, in terms of profitability and capital efficiency, it's all coming into play. So the model now, I think we believe we are at an inflection point where the model will now compound itself. And as we move further, the benefits of scale in terms of profitability will also be visible.
So, okay, so I'm getting you. So, after 2, 3 years, when you are talking of 1800 crore top line, so this model will apply and you will be managing working capital days efficiently. Am I right?
Yes.
Yes. For it. Mhm. Okay, thank you. That's all from my side.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Srinivasan Gopalan for closing remarks.
Thank you, ladies and gentlemen. We always keep looking forward for your blessings and confidence in our company. We thank you for that and look forward for more such updates. Thank you.
Thank you. On behalf of Arisinfra Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.